Basant Maheshwari, partner and co-founder at Basant Maheshwari Wealth Advisors, is joining us right now on the show. Basant, thanks very much. We really had very interesting conversations with you in the past, and in and around those record highs now for the equity markets. We've spoken a lot about what the government has done, the government has heard, the measures that they've taken and what it's done for the equity markets now. Now it's uncharted territory, so we are going to, make a path for ourselves. What's it likely to do according to you, and the excitement around equities even from foreign investors? Is it likely going to come back in a big way?
Two things first. It's again a story of two halves. The two halves. One is the guys who have it, and the one is the guy who don't have it. So if you look, the Nifty is almost at its all-time high. It might break it today, tomorrow, day after. Doesn't matter when it does it. But the small cap index is down, I think, around 40% from its all-time highs. Portfolios are still bleeding in the red, and that's the real problem. But then from the foreigners' perspective, if you see, the foreigners are still net short in the derivatives market. They haven't covered their shorts yet. And if you go by anecdotal historical evidence, till the time foreigners go net long in the derivative markets, Nifty doesn't sustain its all-time highs. So either the foreigners have to come and cover back their shorts, or we'll just keep flirting around these 12,000, 12,100 levels. But for us to decisively break through and move towards 12,500 and 13,000, which we expect that should happen over the next 2, 3, 4 months, the foreigners have to come and buy big time lock, stock and barrel. So, but then that's the thing to be watching out for if you're a Nifty observer. But if you're in the mid and the small cap, then the story is almost the same as it was 6 months back.
But does this probably give you, some amount of confidence that while a bulk of those stocks is still doing what they're doing, the ones that have been, the ones that have been able to wither this, test of fire sort of thing, have done well? And you've seen many of the mid caps and small caps also running up almost 50% in the year.
Absolutely, and now it's back to those things which will be which will show performance in terms of numbers, will get performance in terms of prices. So it's a very selective market, a narrow market, a focused market, a market which respects earnings, a market which goes up on earnings, and there's no question of hope right now. So that way, if you are buying companies basis earnings, I think you'll do fine. You're doing fine for the last 2, 3, 4 months. That's not a problem. But there is no broad-based, buy all kind of stuff right now. You go and you buy anything and it starts going up. So I don't think that's going to ever happen over the immediate short term. But over the medium term, I think the government has decided to do something for the budget. And this is an anticipation of the pre-budget rally. If some big bang announcements come during the budget, I think the market will rally before. Salute the government for that. And post the budget, when the news comes out, I think we might have a correction. But this is just the start of a pre-budget rally. I think something big is coming in the budget. That's what the screen is telling us.
Interesting. And Basant, I was going to ask you that because you read the screen so well. Now, your screen reading in the past, I remember, has told you to stick with those high-quality financial names despite they looking expensive on the face of it. Now, my question is, the last 1 month, the screen is also telling us that there is some activity, not necessarily in the low quality names, but some of the beaten down names which have started to participate. The risk reward from here on until the budget, or maybe, if you're playing for the pre-budget rally or for the next 6 months, is it more skewed in favor of some of those names which have now lately started to participate, or would you still stick to the tried and tested?
Neeraj, if you look at it in the past, the leaders move first, and then people buy the second line, the third lines. Then the leaders move again. Then you go into the second lines and the third line. So from September 20th, so maybe till first week November, it was the leaders that were just moving up and nothing else was moving. They had their first bout of buying. Now the buying has shifted to the other names. But then, for example, no recommendation. If you go and buy a DLF, let's say, for example, today it might go up 250, 300, whatever. But then if it falls 10%, you wouldn't know what to do with it, whether to average, whether to get rid of it, whether to buy more of it. So you don't want to be in those kind of companies where even with a 10% downtake, you're completely unsure of what's the next strategy going to be like. So, it's great to write a value investing thesis on buying the beaten down, the cheap names and all those kind of companies. But the key question to ask is, what are you going to do tomorrow if the stock falls 10%? So those are the kind of issues we have to grapple with. I think it will still be sensible enough for people to just look at the companies that are delivering earnings and stay with them rather than try and make that quick 20%, jump off some random trade like that.